through fundamental investment, through mutual fund, how we should invest in mutual funds, and statistical analysis, all those things. But we are now trying to get a little deeper into what are the important aspects that we should keep in mind as an investor, one, and also as a trader, because we have already mentioned before that trading is something which is there's only a thin line between trading and investment, because trading means different things for different people. If you are talking about intraday trading, that's different. But if you are looking at some sort of a position trading, that is, you're going to take a long-term investment call, and then, but only thing is that if things are not looking that good, you would not like to hold that, so you would like to remove that from your portfolio. That is also your trading, because you can always review it based on the results, based on developments that are happening. For example, let us say Tata Steel. Now, the steel companies or commodity companies are doing extremely well last year. We had already highlighted before that during periods of quantitative easing, during periods when the inflation is on the upward move, then commodity companies tend to do well because the commodity prices tend to go high. But whereas when the central banks of the world try to attack inflation by tightening interest rates, by withdrawing liquidity, then in that case commodity prices tend to fall. We have seen now commodity prices falling from its peak, whether it's crude oil, aluminium, precious metals also like gold, then we have industrial metal like copper, aluminium. So these things have fallen significantly from the top. Even crude oil is down more than 25-30%. It went up to $125-130 per barrel. Now it's slightly around $100. So there will be a 25-30 even 40% decline in major commodities, and that is what is reflected in the price of Tata Steel. It's not that by valuation certain companies are bad or something, but basically they are dependent on what's happening with respect to the fundamentals of the economy, fundamentals of the global economy. That is, a falling price, which means probably the profitability of these companies can get hurt in coming quarters or coming years. So that is being reflected in the present prices. So once you know that particular thing, that's that fundamental macro picture, and also company related picture, because one is that fundamental related picture of what news, of what developments can impact the profitability of companies. At the same time, we also then go with a specific thing about a particular company, because that company's results within its group also becomes very important. So we need to track the macro development for its likely impact on the balance sheet and profitability of the companies, plus within its group where does it stand. So these are two important things. Now once you become confident that the valuation of these companies are high, and there are certain macro developments which are also impacting this particular sector and stocks negatively, then the technical call that you get for a buy or sell can be taken with great confidence. So that is where the fundamental investment picture gives you a greater confidence as far as trading is concerned. Now before we go into what are the parameters that we will dwell and how do we estimate certain things about where we should buy or so, I'll just give you one example. Now for example, let us say tech stocks. So when you are investing, generally speaking, you are investing investment into the difference, main difference between investment and trading, okay, is that when you say investment, you invest in businesses, in the sense that you take a picture about the structural nature of the business, whether this particular business is in sunrise industry or in matured industry or in sunset industry, that is, it is in a declining stage. Then also you take a call of how well it is going to be supported financially, because some companies can be in a very good area, very good sunrise industry, but at the same time there may be other issues regarding its valuations, regarding the funding, regarding its profitability, because the industry may be good, structurally may be good, but the companies would not have turned profitably and would continue to be making negative cash flows, which means that probably we have to avoid such stocks. So once you get a good picture of this, then in that case you can always look towards a buy and sell with greater amount of confidence. Very classic examples that we have seen. One is Zomato. Now, why I am talking about this before going, in order to give you a brief understanding of this, so that you will appreciate that why the fundamental nature as well as the valuation of companies are also important when you take a call. Now, everybody is talking about Zomato when it came. It is a sunrise industry, no doubt about it, and it gives a lot of employment. Structurally, the business is supposed to be good only. But what happens now when the company is not making profit? It is burning cash, and those who came with at a very low level wants to exit the moment they get a higher price. When those things happen, you have a steep stock fall. Now, last couple of days the stocks fell because the 1 year lock-in period got over, and those who wanted to make an exit made an exit. So those early investors who came wanted to go through an IPO route in order to disinvest their shares and make good of the money. So one is that whether the company is also not looking shaky, not from the business point of view but from the financial point of view, that it is still not turning around, and at the same time investors are getting out. Now, another case, a classic, is Uber in US. Now that company also, the technology, the business, everything is all right, okay, but the company is still not able to make that sort of a profit, because they keep on expanding. They try to leapfrog into many growth areas, and finally, they are not in a position to sustain that particular expectation of the market and investors. So we have to understand all those things before we become a smart investor. So very important is a smart investor. Now, being smart does not mean that you should rush, because the market has two important things. One is intelligence and resources you can club. Another is patience. Okay, so the patience are in two places. One is wait patiently till such time you get to buy at correct valuation. Same time, once you are into your stock where business is good and into right valuation, you should also have the patience to hold till such time it makes money, because you do not know when the winds will turn so favorably for you to make money. Example, Tata Motors, Tata Steel. 2-3 years back, no one would have touched these stocks, despite Tata Steel almost going at book value. Now also it has come to book value. We will explain all those things in the course of coming days also in depth. Now, when you get such beautiful big company stocks with great assets at book value or below book value, sometimes investors tend to ignore that. But once you pick it up, then at the right time you will get such a huge price appreciation. I think in the last cycle of bull market, that is till what happened couple of months back, the best performing stock was Tata Steel. One of the best performing stock was Tata Steel. So now Tata Motors at some stage was languishing 100, 120, 130. People are not willing to look at it. Today, look at the stock. Similarly, SBI. Okay, so there are so many stocks which for some time, it looks at good valuations bought, but it does not grow for some time. But it grows at some stage there, rewarding those people who have been extremely patient with that. So investment requires smart investing means intelligence, resources plus patience. In fact, the intelligence can also be a little lower on the lower side, but high scale should be given for being patient. So that means you should have to be patient. You need conviction. That is basically you should know that, okay, that I have done the right thing. But some stage the market probably during certain times can go below a fair value or above a fair value for some time, but it will mean revert. That is, it will come back to its normal state at some stage or other. So things don't go along with what we expect, right? So sometimes it may happen, many times it may not happen. But when you know that this price, let us say for example TCS, now it's 3000 plus, you feel that going by various parameters it should be bought only at 25 or 26. Let us say that's the thing. So you remain patient. If you get, you buy. But if you buy at 25, 26, assuming it drops down to 221, 22, then in that case you need to be patient. Probably invest a little more because it is coming to much below fair value, which you expect it to be 25, 26. Then it comes much lower than that. Then you should be a little bit adding to that. And then once stay patient, you will get a good reward at some stage there. At the same time, you should not make a very hasty exit also, but you should be very careful about it. That way, when you look at business, you should not look at the names behind it, because there are big business, there are big names, and names which have consistently rewarded. But at some stage there, business is good, but the valuation can be very FT, and it may not rally for a long period of time. Even Reliance Industries, for that matter, for a very long time, in the last couple of years, it just once it broke that 1,200, 1,300, it rallied closer to the 2,728. But for a very long period of number of years, even Reliance Industries was stuck. Now that's one classic example. Now I will go to that chart straight away to illustrate as to why that is very important for us to understand all these things, so that we don't need to make a mistake of just rushing in to say that because it has corrected 10-15%, we should go for a buy. Now see, go to the monthly chart. So this is the period, I would say this is the 2009. After that there was some rally. Okay, now we will leave this portion. Just see, this is the period of 2010, right? 2010, 541, 341. Okay. Now let us see how it was stuck in this particular period. It was 2010, and you see this range was not broken till 2017. 2017 only it started to break, somewhere 2017, right? So nearly for 7 years, Reliance itself was stuck between 540 and 340. It was stuck between 540 and 340. Then after that, in 2017, when with the launch of the Geo, retail, and other thing, heavy valuation spiked the market. So same time, we should not get carried away just because it has grown from this thing. We cannot make an extrapolation. So the fundamental mistake that we do is we chase stocks which have already done well. Okay, so we have to be very careful about not chasing stocks which have already run very well. Reliance itself is one case, a very important thing, that it has already rallied very heavily. Now chasing the stock for a very, very high return, see, those people who are holding this particular stock which have been bought at some lower level, fine, and it's a very long term study and you're going to get rewarded over a period of time, fine, because we do not know what all the areas where they may go into it, which all may be profitable. So you don't need to sell. That is okay for those. But right now to go in for a buy because it has already grown to this extent based on hope is not correct. So we have to see where it stands with respect to the present scheme of things, and probably factor in what is likely to happen to some extent in order to give some value to the future growth. So this is a very important thing. Now same time, if you see, now this classic thing, we will go to SBI in order to make the same understanding. State Bank of India. Now State Bank of India, in the last decade or so, it never fell between 140, and the entire decade it never went above 335, and most of the time it was between 140 and 335, 140 and 335, and the average you can say around 230, 240 levels. Okay, so that particular time people are not willing to bet too much on SBI, the ability of SBI, because the POC banks were in great trouble for a long period of time. Once the turnaround started to happen in the 2020, and after that when the NPS started to fall significantly from 2019, the stock has zoomed. The stock has zoomed. Just because it has zoomed, it does not mean that it will not have further value. We have to see now what the value is right now. Whether where does it stand in comparison to its peers? What are the likely chances that it can still go up? So having zoomed, it does not mean that it has no potential to go further up. It has a potential still to further go up. So when you have the fundamental news, fundamental information, intrinsic value of a company, all those things with you, then in that case when you give a call for buying or selling, then in that case you can take that particular thing with greater conviction. Now, without going into the till now into the fundamental thing, let us say for the last couple of months, though it fell, it has not gone below 430. If you see, ever since September 2021, in another 1 month we are going to get into that. So for the last 1 year, despite so many negative news which have happened, like inflation, Russia Ukraine war, all those issues, the effects of COVID, with all those things, still the stock has held on to the 425, 427. So we have to find out whether that 425, 427 is a base case scenario as far as the fundamental point of view is concerned. If that be the case, then any dip which came, very recently, or even this particular month, when it started to rally above 470, 475, when the technical call comes, buy above 475 with a stop loss at 427, immediately you can buy, because you have a fundamental thing along with you. And the trading technical call also, now, because the technical analysis helps you to fine tune the entry and exit, right? But basically what forces you is, see, because when you think about it, those for example, those people who do not want to put too many stop losses and don't want to get into day-to-day trading, they just want to take a slightly bigger call, 5%, 6% stop loss type, based on solid conviction that yes, this stock is unlikely to go much below this, and even if it goes below this becomes a buy. So we will hold on to that. If that be the case, then in that case the technical thing analysis helps you to fine tune. How does it fine tune? You put in all your technical parameters. It could be moving averages, it could be super trend, it could be the same bar chart, how you understand the bar chart. Based on that, you can go for a long or a short. Now, under the same question here, HDFC Bank will. Now, HDFC Bank has fallen in the last couple of months. It has not gone below 1275, 1300. So, is it now coming into now the question now is that whether around this now 1393, so maybe 1325 or 1350, is it fundamentally now a good place to go for investment? That is the first thing that you should call for. Okay, so call for the information to understand that the HDFC Bank is a very decent place at around 1320, 1330. If it is going to go even further lower after the investment, where should we add that extra quantity? So these two things are very important. Now the stock has fallen from 1700 to 1400, which is 300 rupees, means almost 20% fall has been there in this thing. So 20-25% fall, is it okay as far as, or has it got the potential to go even further lower? To what extent, if it is going to go further lower, what is the basis on which we should undertake all this? Probably for that, to some extent, the fundamental analysis will be very important. And even for Nifty, now let us say Nifty is at 16,483. Generally speaking, when you are going for investment, you will first look at the index, right? So because if the index does well, and most of the let us say the fund managers gives a 3-4% return more than the index by putting it in multi-cap, mid-cap, or small cap, or flexi-cap, whatever it is, or sectoral thing. And in that case, first of all, that you must get a conviction that will the index rally? Will the index rally? Where does it stand right now? Whether this is a fair value for investment. Then if it is a trading call, how we should take the trading call, and if it is going to fall, to what extent it is going to fall, and from where we can make our investment or trading call. So this is these things should be studied to some extent. I'm not saying that you should become like a finance or accounting person, but overall you should know whether index has come to a fair value, index or to a fair value. So what are the measurements which will indicate that this level is a fair value? Let us say, for example, we start with Nifty, then probably we look at Bank Nifty, probably you can look at some banking stocks, look at some stocks like Reliance, TCS and all. So slowly the understanding will help you to know that which, because when you keep talking to some people, don't get carried away by the present momentum of stock, because every day, the movement can be based on certain noises. Like, some news will come here and there. It can go up, it can go down. So your smartness is going to come from filtering the noises, and also to stay with the real big picture. Now, results have come for many stocks. Results are going to come for some other important stocks also. So basically, a major portion of the Nifty stocks have already been reported based on the important banks, technology stocks, Reliance and all have got reported. Maybe someone has to come like L&T, SBI, all those results have to come. Tata Steel has already come. So major reportings have come for the last quarter. So based on that, you may be making a measurement of what is the likely scenario as to how the growth of the Nifty stocks is going to be. What is going to be the Nifty growth? All those things. Once you start mapping out, you will have to first know what is the fair value of Nifty itself. Okay. So what are the measurements that are important as far as measuring the Nifty? So when you came to the fundamental investment, price alone is not the only. You are only looking at the price. That is 16,500, 18,500. Many times when they say that it has climbed to the peak, okay, that itself is not of any relevance. What is very important is whether the valuation is becoming stretched. Whether valuation is becoming stretched. If it is stretched, what is the factor that plays in stretching the valuation? Now we must understand there are certain extraordinary circumstances, and those extraordinary circumstances either stretch the valuation beyond a certain limit or bring down the valuation below a certain limit. So we should try to take advantage of those things to either make an entry or make an exit. Now when I'm saying that, the example that we could give is in the month of March 2020, because of the COVID pandemic, that particular month index fell, stocks fell, and there was a general doom scenario. People are not able to understand, and the fear factor was also there. Regarding how all these things is going to map out, what are the further negative implications for financial markets. Now that time it was a panic thing, so there was a fear always in the mind. But smart investors, if you see the next couple of months itself, it rallied. So that means big funds came and bought. Now, what was the reason for that big crisis was met by an extraordinary amount of monetary pumping. That is, immediately central banks came and they pumped liquidity into the system. So even not minding or not knowing or not be able to project the ramifications of the company earnings, which guide the markets in the movement, it was bought heavily because money circulation was there. So there are many factors which affect the market and stocks. So the major factors that were affecting, one is of course the valuation. We must know the valuation. Then liquidity support to the market, interest rate. Okay. So these are very important aspects. Now, normal valuations can get exaggerated sometimes by certain events or liquidity supply. Now, what was this event? It was a COVID pandemic. This was met with extraordinary liquidity in the market. When this happens, the normal fair values are being pushed to an extreme level of valuation, and that is what happened ever since that 2020-21, when the market zoomed to 18,600, 700 levels. The valuation was expensive. So why now when I say valuation is expensive, what is the parameter that I am using? The reason I am trying to take you step by step. Now when we said this, that these are important things. At that time the companies were doing the earnings which was coming were not in great thing, were not looking that bright, or it's very difficult to even forecast what could probably happen. But that time in the market zoomed and gave an extreme amount, 18,600. It was known that this is not a this is not the proper valuation. So it has to come down. Okay, it has to come down. Now, what are the valuation parameters, the initial parameters that we normally look at for Nifty. Then of course we'll come to the stocks. Now the Nifty, generally if you look at those people who are doing the fundamental valuation, we will be talking about earnings per share. We will be talking about price to earnings, that is PE ratio. So I think these are the first two things that if you look at it, the commentaries or will be coming forth. And there are so many other factors which we will start looking at it. Price to book values, then we have the enterprise value to EBITDA. So these are the thing that we will keep knowing. Enterprise value to sales. So these are financial ratios, price to sales. So based on this, the fundamental analysis, he works what is the fair value of a particular stock or what is the fair value of the market. Okay. So let us look at the first thing that probably we try to understand. What is earnings per share? What is the price to earnings thing? Okay. So the earnings per share. So when you say is the total amount of money that is being made by a company, that is the earnings, right? So what does it mean in a normal language? We'll try to understand the normal. What is the net profit of the company? What is the net profit of the company? So that's the earnings of the company, right? So every year, what is the earnings of the company? So because you have certain parameters which you know, that is net profit of the company, that is after tax. Okay. Then what is the outstanding shares the company has issued? What is the earnings per share? That is for every share. Okay, that is number of shares issued might have been 1 lakh, 1 crore of some face value. It could be 1 rupee, 2 rupees or 10 rupees. So what are the outstanding shares? Equity shares, and what is the profit? In a very normal way that we try to understand. So the profit, number of outstanding shares, let us say that is the earnings per share. That is the earnings per share. Now, what does it mean? That is how. Now, let us say the easiest way to understand is. Let us say TCS. Earnings per share is 105 rupees. Let us say earnings per share is 105 rupees. That means the total profit the company makes for every share that you own, you are making 105 rupees profit. For every share that you hold, it is making 105 rupees profit. There will be some other company which for every share may be making 10 rupees or it could be making 150 rupees. So that is the first parameter that you try to understand, that what has been the EPS, what is the growth rate of EPS over a period of time, or what is the growth rate of the net profit over a period of time. If the common equity shares are same, let us say what is the net profit in 2011, to what extent net profit is right now, what is the growth of the net profit from there to year, which to some extent will be equal to what is the net earnings per share growth from that particular period to this period. So normally what should happen is, this is not exactly 1:1. The price should reflect that particular growth. Not necessarily it should be 1:1. That means what I'm saying is, let us say in 2011, the company made, let us say, 10 rupees per share. Okay. And in 2022, let us say it is making 50 rupees per share. It is 50 rupees per share. Okay. Or net profit at that time was 100 rupees and now it is 500 rupees, let us say. So between 2011 and 2022, this should be giving approximately, if this has grown by 5 times. Okay. The stock price also should to some extent reflect this particular growth. Should also reflect this particular growth. So that means it should be something like the same 5 times, right? But if you look at the chart, it did not happen. We will come to all those nitty-gritties now when you look at the other ratios. But generally speaking, it's a very common thing. No? If my growth is good, then in that case it should be reflected in the value, in my value also, right? So that means what? In a company, when you are contributing and when that contribution is being measured, then in that case you are contributing sometime back 1 rupee to the company. Now you are contributing 5 rupees to the company. Definitely if you are earning 25,000, 1 lakh per month, the company would have rewarded you now. So it should, but you can't say it should be exactly 5 lakh. maybe your salary might have gone to 3 lakh or 3 lakh 50,000, right? So in some proportion, but the direction has to be maintained. To some extent, the proportion will not be the same, but the direction will be maintained. Okay, to a very large extent of correlation, right? So you can't say that I contributed so much to the company, but they have just given me 10% more. So that is a total undervaluing you, right? That is the same thing here. So generally, it should be in proportion to the net profit growth. So what has been the growth of the EPS from that particular period to this particular period? You should have some relation to that in the same direction. That is the first thing that we should understand. So now, once you know what is that, once you have understood the EPS, what is the market rate? Now you know the market rate. Let us say Nifty 16,500. That is the today's price. This is 16,500. Now Nifty 50 companies, if you take, let us say the EPS as the trailing EPS, okay, as they call it. That is trailing EPS means what has happened till now. What has happened till now? Now in this particular quarter, if you discount that March till March quarter, it was something like a 775 or so. 775. Okay, 775. And presently now that EPS now looks to be for that annual thing is coming to 815 or so. 815 or so. Okay, so this is the you can call either this is the March figure and probably this is the updated figure. So let us say in 1 year from now, because you will be looking at some growth point of view, right? So 1 year from now, what will be the this 815? Now if you look at it over a period of time, there is a profit growth, like the entire Nifty 50 has a profit growth. So we most of them will be looking at some consensus growth, which is approximately equal to the nominal growth in India. At least nominal growth in India is the actual GDP growth plus inflation. So if inflation is 6-7% and the normal this one is growth is around 6-7%, so that means there is a 14% growth in GDP. Let us say in nominal minus the inflation is 7%, but when you take along with inflation, let us say it becomes 14%. Okay, so the expectation is that if the GDP is to grow at that particular rate, then in that case the companies which are contributing, because these are mega companies which have a major say in whose constituents are a major say in the Indian economy, and its growth also has a rippling effect of growth in other stocks, in other sectors of the economy, both in organized and unorganized. So that means expecting something like a 14-15% growth is something which we should be looking at it, right? Except in a recession time. Recession time means zero growth. Okay, so a zero growth, and then inflation figures that you put it. Okay, so this is a normal expectation for a growth. Okay, so let us say last year March was 775, or now just June is 815. So as on 815 means next, now 815, if you do 16,500 divided by 815 is approximately 20, right? So this is PE, that is 16,500 divided by 815 is 20.24. So now what is PE? PE is price to earning is market rate divided by EPS. This is market rate, market divided by EPS. This is PE, price to earnings. That means when you say this is 20, let us say 16,500 divided by 815 is approximately 20. When you say is 20, so that means if the earnings is 815 rupees, then that means in a very layman understanding, that means you need to wait 20 years. It's an approximate understanding of that, right? So you need to wait for nearly 20 years in order to get your value, right? Because you are investing in now with a growth of 815. Okay, so that means in 20 years you are expecting if this earning is to be maintained. Okay, because this was going to grow. 815 is going to grow at 885 or something like that. So probably over a period of time, the number of years is going to come down. But I'm saying from this point of view, as you things stand, because this is going to likely grow at 10%, 14% every year. So probably you will get to this particular figure sooner than later, right? Sooner than later. Then it's not be 20, it could be even 10 or 8, 9 years before you really get into this 16,500 level. That means what I'm saying is the company's earnings will, the earnings per share will increase in such a way that as if you are the owner, that means you are earning because you are a shareholder. That means you are earning this much for the price that you are paying. You are now paying 16,500 rupees, and somebody says that that is you are earning potential 815 rupees. That means every year you keep working and you make that 815 rupees. It will take 20 years for you to grow to that if 815 is the same. But 815 will grow at 10%, 15% every year. So probably this particular number of years over a period of time will get condensed to 10 or so. So how do you get the compensation for that? The compensation is this 815 will keep growing, and based on this you will get a growth in the price. You will get a growth in the price, and that growth in the price should correspond approximately to the, now if you are at 20, should approximately correspond to the growth in the EPS. So that means 815, if the price, if this is going to grow, let us say at 14% next year, 815, I'm putting it at say 14% growth next year, it should become 930. It should become 930, right? So it should become 930. Okay. So with the same 20 EPS, 20 PE which is now there, I may get what? 930 into 20. So next year, if I have the same PE ratio, it becomes 18,600, which is the top. So, but whether this is going to be, now this probably I'm forecasting, but whether this is going to be 20 or whether it's going to be 22, 24 or even 28, or whether it can sink something to 16. This is my question. Now, for which we should understand what has been the general Nifty price earnings over a period of time, what has been the maximum, minimum, average, so that you will be able to do some forecasting about that. Let me say that except the Lehman collapse period, even during the pandemic time crisis, it just came to 15.9 or 16, that one particular month. After that, generally Nifty, if you see, for most of the time it will trade about 20. Most of the time it will trade only about 20. So that is what we have to see from the chart. That is what you have to learn. That is what you have to get some feedback. How many times it has been more than 20, and how many in the last so many years and months, and how many times it has fallen below 20. So that will give you to some extent the probable loss of buying the index at 20 PE. Now let me say at one point of time it had dropped to 16. So assuming the same case comes, so 20 to 16 is 80%, so 20% loss. So from this, the maximum loss that probably you will have, that is when you're buying at 16,500, I think the maximum loss can be 20% immediately. Within 1 year, what could happen is this probably will grow, right? So because this could be market driven for some event related reason. But if the earnings come through, so the most important thing, this disappointment should not be there. This disappointment should not be there when you forecast, because when the disappointment will come, it could be a recession, companies going into a toss. If all negative things come, then it's a problem. Now, if you are expecting the growth to be like this, if you're making a projection, so you have to keep an eye on the macro thing. Okay, so if you are expecting this to happen, which we are on track still, Indian economy is still on track for that. So if that be the case, then we should be looking something like a 930, and within 1 year, even if you have bought this, what is 1 year later on, if this materializes, the worst thing could be 930 into 16, in case if something happens, event related, because if this is going to grow, to this extent, this will not come. This should not come, except like pandemic time, which I told you. So the worst could be 15,000 if it happens that this growth happens, but this this comes due to some event. Okay, so the worst could be 15,000. So what probably we should do is, if at all the market falls from 16.5 to anywhere around 15, because we touched 15, right? We touched 15. So that means anytime you buy closer to that particular price, I think you are building a huge amount of safety net, because if at all you are buying closer to 15, we are trying to understand the valuation point of view. If you are going to get something very closer to 15, what could happen next year? 930. Okay, so 930, you're going to get 930, let us say, and 930 into even 20, 18,600, and you are buying closer to 15k. So getting 3,600 rupees, which means more than 20%, right? 22, 22, 23, 24%. Okay, and if this goes up further, because sometimes what happens is you may look at some extremely good values, right? When does it? Why does it happen? Because this PE itself may not be 20. For most of the time, the PE in India has averaged 24 to 25, and anything about 25, 26 is a risky game. Okay, so if this assuming grows by another to 24 or so, and this also materializes in a bullish situation, then it becomes 930 into 24. It becomes 22k, which is an extremely bullish scenario. But mind one thing, that 23, 24 has happened even in normal times. That is not, see, this last year the P went up to 34, 35 because of extraordinarily very high amount of monetary pumping. We should remove that scenario. That is why if you see most of the stocks right now, they are looking expensive from the PE point of view, because still that froth is yet to get eliminated. Now, the reason why Nifty is at a decent level compared to many other stocks is because of its constituents of Bank Nifty, which is all trading at because Bank Nifty is around 35%, that is there, and then you have got cement, steel stocks which are also contributing there. So these are the stocks, and also there are some tech stocks which are below 20 PEs also. So because of this, the Nifty is trading at this 20. But there are very quite expensive stocks, like FMCG stocks are quite expensive. Then you've got Reliance, which is expensive right now from the point of valuation. Then you've got TCS still going at 28, 29 PE. So there are stocks which are accounting for 25 to 30%, which is still quite expensive. And that is where the problem can be for Nifty, because those stocks, if it is going to get corrected, then that means there are rest of the stocks have to go up in order to maintain the 20 PE. Now we saw this 18 PE coming, week 3-4 last month or so. It fell down to 15,200, and at 15,200 divided by 815, it came to 18.65 PE. So the normal thing, if you will look at the chart also in future, so the PE which fell down to 18 and a half level, I think it's a very great scenario, because normally you don't get this. You don't get this at all in most of the bullish times. You don't even get 2021. So this is an extraordinarily important time. Of course, there are those who can say about this. This is from the point of projection, from a bullish point of view. There are people who will talk about that. See, the company is earning now. What is the pitfall? We must understand. What is the macro picture which can turn the argument against this? Basically, that you can say that the recession is going to get entrenched. Higher interest rate is going to lead to companies having have to downgrade their guidance. So we have to watch. The major tech companies are now coming out with results today, tomorrow in US. So when you look at the guidance, when you look at the results that are coming out in India, that will give you an indication of what the likely growth pattern is going to be. So whether that is going to come to EPS of 930, or whether it is going to come to slightly lesser scenario, which means that probably there will be growth, but 815 instead of 930, it only turns out to be 875 or 880. 875 880. Even with 875 880, if at all it is going to go even at 20, now this is going to come to 875 into 20, it will be 17.5. So you do anything even below 16,000, you still get 10% return. Even if the EPS does not go up to 930, 940, and we stay at a PE of just only 20. Okay, and so better to buy something closer to the 15 k in Nifty, you are building a huge amount of safety net, and if it drops down in further, we are going to buy more. So this is one factor that we normally take. So we will analyze this from various stocks. For Nifty, we have looked at it, Bank Nifty. We'll also look at the global index. So we'll go step by step with these parameters, and then because we will also talk about mutual funds, which are so. Since I just told you about the EPS and PE, we'll just have one discussion about what is a balanced fund on Thursday. Then again we will revisit this next week. Okay. So now there's only a part one, step by step, in order to give you more maturity as far as the view that you take on the stocks, and this we are going to combine along with the technical analysis which we did for position trading. So when we look at the individual stocks, when Nifty, we will also look at the technical aspects of the market presently. We'll look at where we should look towards buying, and from the technical point of view. With this, we'll be in a position to get some more advanced way of trading, and so that you can look at, because not everybody will be quite keen to put frequent stop losses. But at the same time, we should also guard against extreme amount of losses. So, and also how do you do the contract sizing based on different views. These things will definitely help you in all these things. So we'll look forward again for the discussion again to continue next week with a small diversion regarding what is a balanced fund, what is which are the funds which are doing well, what type of investment we should go. Along with that, we will also look at this on Thursday. So thank you very much. So you can ask your questions now. This week trend in Nifty, right now it's getting down. Now if you look at the chart, so till now there is a small fall, but you will get a 16,300. You can keep 16,300 to 16,750 as a likely range for this week, and this particular trend line, so this line is very critical. This line is going to be very critical, and that is now coming closer to the 16,200 levels, right? So today it is 16,000, tomorrow 16,170, and after that it's going to it's just going at a range of 35 points every day almost. So this is around the 16.2, I think is going to be very critical for the market. Any fall below that, I think 16.2, 16.250 could probably turn the market towards a bigger fall, which could probably target this particular level. See, this is the 15,730. So now we have gone closer to this. So I think I still feel that even if there is a fall below this particular level, we can see some sort of thing closer to 15,730. That is what I'm saying, that when you look at from the fundamental point of view, you should be looking at this. But that is not going to be for this week. This week it's going to be mostly between 16,275 and 16,750. So thanks for your participation today. We'll see you on Thursday again. Thank you very much. Stay safe. Good night.